Hey, good afternoon, everyone. I really appreciate your coming in, giving me your time this afternoon. I'm going to show you a lot about our market profile. It's really a very, very unique tool. And so let's move forward. Just we have to open with the disclaimer that the signals and trading opportunities provided, both orally, written, or electronically, that are disclosed or for subscribers or for educational and demonstration purposes only. That we are not certified commodity trading advisors, and that you should consult a broker before making any type of trade. And that's about it. Just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson, Philadelphia, and I've published close to 15 peer-reviewed articles in top-tier journals. And I've been involved in the financial markets for over 20 years. And Right Line Trading software is a product of a decade of analysis of price action, market structure, and indicator algorithms. And the software is based on mathematical modeling of closed system using multivariable equations. And what we do is we look at all the independent forces that come to bear on price in any given financial market. Each one of those forces is an independent variable. We put that independent variable into a multivariable equation, and then we optimize it. And we are one of the fastest growing trading systems on NinjaTrader. And what I'm going to do in the next hour is I'm really going to show you how to find very low risk, high reward trading entries. The system I'm going to show you is operational in futures, forex, and stock markets. And the thing about any trading platform or trading system is if it's not operational on all financial markets, independent of time frame, then it really hasn't found real independent forces that come to bear on price in the financial markets. Now, respecting volume profile generated areas of support and resistance is a critical fundamental component to successful trading. I'm going to show you how those are generated. I'm just going to move forward. Now, here is a volume profile, and it can be configured on a daily basis, a weekly basis, a monthly basis, and what it shows you is the amount of volume that crosses in any financial market at any given price. And I'm sure you've seen these kind of configurations before. Now here's volume profile, and it creates certain critical areas of support and resistance that you really have to respect if you want to take low risk, high reward trades. In this particular case, this is the point of control. And the point of control is where most volume has crossed in any given individual price. And this is the value area high, and this is the value area low. And within the value area high and the value area low is 1 standard deviation's worth of volume at price, or 66 2/3% of all volume at price that has crossed the ticker in that individual trading day, or it can be over a look-back period if you store volume in your indicator. Now, what makes it such a powerful trading tool is that it's really based on very, very sound fundamental math. Unlike a lot of the things that we see in trading where we're given black box systems to trade or different indicators based on different formulas that we're not sure work, this is really based on very, very sound mathematics. Now, in a perfect world, the random distribution of data would form a bell-shaped curve such as this, where the mean price is right here, and in a perfect bell-shaped distribution, the mean price, the median price, and the mode price are the same. And then there's an envelope around that mean price that comprises one standard deviation's worth of volume at price, and that creates a fair value area for that given financial instrument. And you're going to see that price really tries hard to stay within that fair value area zone. And here again is the same representation. I mean, essentially it's a bell-shaped curve, even though it's represented slightly differently. A perfect random distribution of data. And the point of control is the mean price, and the value area high and value area low comprise one standard deviation's worth of volume. Now, this is our volume profile or our market profile. It's based upon this histogram. Now, right now I have the histogram set small, not extended, so I can clearly delineate for you the value area high and value area low. Now, what I put in here with this blue is where the point of control would be if the data was perfectly randomly distributed, but it's not. So the value area high is here, value area low is here, and the point of control is here. And the point of control is a terrific area. It's a tremendous area of support and resistance. You don't trade into it. And it gives you great trades if you're sitting on it and you trade off of it long, or you come up to it and test it and trade off of it short. And from between the value area high and the value area low is 66 2/3% of volume at price. Now, what happens when price approaches the value area high? It's going to get rejected down. And when price approaches the value area low, it's going to get rejected up. Because traders have already determined that fair value for this given financial instrument, in this particular case it's crude oil, but it could be a stock, it could be a Forex pair, it could be any future, does not make any difference. They want the price of this financial instrument to be between the VAH and the VAL. And while the VAH and the VAL reject price down and up, the point of control is a price attractor. It's the price in which most volume at price has crossed. So traders want crude on this given day, February 9, 2017, to be $53.49. So it's a tremendously powerful area of support and resistance and attracts price towards it. When they say regression to the mean, in this particular case, this is sort of a mean price. Oops. Okay. Now, in addition, you know that the value area high, value area low, and point of control are constantly changing. what's extremely powerful about this particular indicator is that it changes these areas intra-candle. Every single time this profile or histogram bar, set of histogram bars change, the VAL and point of control change with them. And the problem with almost all market profile indicators or systems is that they don't change until candle close. Now, if you're trading a 3-minute or a 5-minute or a 9-minute or a 1-hour bar, you can't configure your trade to take an entry because at the close of the candle, the point of control can just jump right in front of it. So you have to have a system or indicator that's constantly changing the really critical volume areas, volume-based areas intra-candle. Now, besides the value area high, value area low, and point of control, there's also critical low volume nodes. And these really also make a huge difference. Whereas the point of control is the price where most traders want this financial instrument to trade, the low volume nodes are areas where almost no volume at price is crossed at all. So this is a price where traders have accepted, in this case, the E-mini to be, and want it to be. These are prices where they have rejected this price. Almost no volume is crossed at these two particular prices. So price, when it rises into that low volume node, is also going to get rejected. And when it moves down to this low volume node, it's also going to get rejected. Now it's rejected for a different reason than it's rejected by the value area high and value area low. So it's an independent force that comes to bear on price when it approaches these areas. And that's what makes these areas so important and also so powerful. When price rises, now we call these zones of rejection. They're not areas of support or resistance, because when they're broken, when an area of resistance is broken, it becomes an area of support. When an area of support's broken, it becomes an area of resistance. It's simply a rejection zone. When the low volume node and the value area high here and this low volume node and this value area low here are confluent, this zone here becomes very, very difficult to price to penetrate. Now, obviously, sometimes it will, but on a statistical basis, if you trade into these areas, price will far more commonly be rejected than it will penetrate. And on the right edge, these zones are constantly changing every time volume profile changes. So they have to constantly be monitored as you take each individual trade. Now, I've seen a lot of volume profiles or market profiles creates zones of rejection and zones of support. They're red or they're blue. And that's really an inappropriate use of market profile. Remember, when support is broken, it becomes resistance. And when resistance is broken, it becomes support. So you can't label a rejection zone or an area that's difficult for price to move through based on volume profile as red or green. It's all dependent upon where price is in relationship to these zones. So this is an inappropriate labeling of these critical volume areas. Now, this is the way volume profile is all I've seen on many charts. Now, this is the market delta. And all it is the raw data plotted below the candles. And this is the market delta value of each candle. And what it tells you is whether or not there's an overabundance of buyers or sellers on the trading dome at any given time. If the delta is positive, there's more buyers all the way across as far as market depth is concerned. Now, the color of the market delta does not necessarily correlate with the direction of the candle. You can have an up candle on a negative market delta, and you can have a down candle on a positive market delta. So if you're going to look at the market delta of each candle as being predictive of the future direction of price, it's got to be put in a smooth moving average to eliminate those outlier candles and where the delta is the opposite color for the direction. When the delta is negative and the candle goes up, or the delta is positive and the candle goes down. In addition, if you look at the different tick levels, you see that there's the bid and there's the ask. There's the buy-sell imbalance, or the buy-sell number of contracts at each particular tick level. And if you use that as well, you're going to find, at least in my opinion, that you're going to go a little bit crazy. So what we've done is we've leveraged this data to make it much more powerful and much more predictive in terms of where price is going, what direction price is going to take. And although it's the same data you see here, and this is the data in raw form, and the way it's projected on many market profiles, and it looks elegant, it's very, very difficult to use to predict where price is going to go. So here's how we have reconfigured it and how it sits. Now this is the Sierra Charts version, and the Sierra Charts version really gives you a beautiful, very clear-cut picture of what volume is telling you at any given time. This is the point of control. This is the volume weighted average price, or the VWAP, and here is the value area low. Now these are all significant areas of support and resistance. What's even more powerful is intra-candle. It tells you, it shows you where the point of control is. And the point of control is also known as the commitment of traders. And when the COT, or commitment of traders, is at the bottom of a candle and surrounded by intense buying on a long candle, on an up candle, you're very likely to get continuation of price to the upside. It's almost like that point of control, or COT, anchors that long candle. There's a huge amount of volume at the bottom, and it's surrounded by intense buying, and price pushes off of that area to move to the upside. Now, I just wanted to show you how each candle is configured. Now, there's also an alert configured, and when you see this blue background, you know that there's a large imbalance of buyers versus sellers in this particular candle. Now, it doesn't guarantee a continuation, but it makes a continuation of this trade very likely. And what's really important about this signal when it fires, if you're approaching here upside resistance, this is the point of control, you have to make a decision as to whether or not you're going to exit the trade, take your profit, or there's a chance that this upside resistance is going to get broken. Well, when you see this fire, you know that there's such a powerful push to the upside. There's such an overabundance of buyers here as opposed to sellers that the likelihood of upside resistance being broken is much greater. Now, so it's this yellow tick value, and sometimes it's a little bit hard to see on a green up candle. That is the point of control, the commitment of traders. And when it's surrounded by these light tick levels right around it, it shows that there's intense buying activity right at the commitment of traders level or the point of control level. And you can see that the candle is configured so you can see where the candle body is and the wick. And in order to reinforce that, this purple line here, sort of this grid to the left, also tells you where the candle body is and where the wick is. To read price action and market structure, it's very important to know the size of the candle body and where the candle body is and where the wick is. Now, to give you an example of a trade, what you have price coming up here, and then you have a retracement right back to the value area low. And you can see that the point of control, or this yellow tick level right here, is in the lower body of the candle. It's almost at the bottom of the candle body, and that's really where you want it. And at the initiation of the trade, that's a perfect long trading entry. And the likelihood of getting follow through and getting at least to your first target is exceedingly high. You can see it's a large candle body, a tiny wick, and the commitment of traders is all the way at the bottom. And although I didn't make this candle big, this commitment of traders is surrounded by lots and lots of intense buying. And the trade moves up and up. It moves right through the VWAP, or the volume weighted average price, and continues. And then, as you see this abrupt drop in the point of control, or COT, and a complete loss of the candle body, this really becomes a doji. You get the reversal candle. Now you can leverage this reversal candle again as a pullback to support. The commitment of traders is right at the bottom of the candle body, and a continuation trade again to the upside. So the COT, or POC, of each individual candle really is a tremendous predictor of price continuation. I mean, it is telling you what buyers and sellers are thinking in each individual candle. And in the context of market profile, the value area high, or the point of control, the value area low, it's an extremely powerful signal. Now, lots of traders try to call tops and bottoms. Now, I just want you to know, this is the Sierra Charts version. We also have a Ninja Charts version. It works just as well in either market, on either platform. And I personally like the Sierra better, but ultimately each one of them will work for you. Now, if you're trying to call a top on in a given market, it's always treacherous to counter trend trade. And I don't necessarily recommend it. But if you want to do it, it's when you catch the very, very big moves. And it's really important to see where the COT, or POC, commitment of traders, or point of control is on any given candle. Now, in this particular case, price approaches a real difficult area. This is a major area of resistance. Here's the value area high, and here is the point of control. Now, you see right here, here's the commitment of traders, and it's more towards the middle of the candle body. Now, price falls anyway, but this is a very risky reversal trade to take, because the commitment of traders is not at the top of the candle, anchoring that short candle to the downside. So price comes back down to support and comes back up to the point of control. Now the COT, or POC, is almost at the top of the candle. It's clearly at the upper 1/3 of the candle. It's right above the candle body and right below the area of resistance. And to put it this way, the commitment of traders or point of control has not broken this area of resistance. And here is a great place to take a reversal trade. One tick below the close of the candle and down. You know, it's not a home run, but it's a nice, solid trade. Then you get a move back up to resistance, and the same thing occurs again. Here the POC or COT hasn't penetrated the value area high. It's right at the top of the candle body, and it's surrounded by intense selling. It's fairly light red tick levels right around it, and that's the place to take the reversal. You're going to get a little bit of a bump here. It's not going to stop you out, and you're going to go all the way down. In fact, it's good. This is going to penetrate the 50 and continue through. So if you're looking for lower risk, higher reward trade reversals, you have to have the POC or COT with you on the trade that tell you that traders are loading up in this candle to push it to the downside. And you see this bounce came right off of support, but then it retested support and followed through to the downside. Now here's the same thing in the opposite direction. Now on this trade to the downside, the point of control or commitment of traders is all the way at the top. And even though, and here is the value area low, this black line. And you can see here we have volume profile extended all the way out. The blue is the area outside of the value area high and value area low. So we're at the value area low right now, and you can see we're in the gray area here in which the volume bars are within those two value areas. We approach the value area low. The commitment of traders or point of control is actually in the upper one half of the candle. We get a bounce, hits resistance, and then comes right back down. Here is where the point of control or commitment of traders is almost at the bottom tick, and there's really intense buying here. These are very, very light green candles. As you get into the trade, you get an intense buying signal right here, which almost guarantees a continuation. Now, then you have to make a decision whether or not you're going to take the trade out at the point of control, and you can see you get a bounce. Now, here it's not clear whether you're going to get it, whether you're going to break it or whether you're not going to break it. If you exited the trade here, you made nice money and you did well. If you stayed in and you weathered this bounce, you got the continuation all the way up through the 50, all the way up to here. You got an enormous trade. The point is that at the initiation of the trade, the risk you assumed was low because the point of control or COT was sitting right on top of the value area low, surrounded by an intense amount of buying. So the entry was really a low-risk entry. The next candle told you that there's an intense amount of buying here, buys you the next candle, then becomes your first decision. If you exited the trade here, no problem. If you are on a trailing stop and the trailing stop allows you the bounce and the continuation, then you get the entire trade. We're not going to try to build an automated trade management strategy here. The only thing that's critical is that you enter the trade when it's at a low risk, in a low risk position, and you have the potential for high reward. And if you don't leverage this parameter, you simply cannot do that. Now here's another trade. This is on the E-mini. Now I don't want to talk about this the background color. The point is that price is hovering right on top of support. And it's actually in a period of consolidation as price moves sideways. Now, when is it going to launch out of consolidation and continue to move to the upside? It does it when the POC or COT is at the bottom of the candle, and again, there's a lot of intense buying surrounding it, and boom, up you go. Now, when do you take a counter trend trade? And this is a counter trend trade. You could take it here, where where the price breaks the 50 and comes back up to resistance. And if you did, you wouldn't have gotten hurt. But if you didn't, and you waited for this double top, you get this POC or COT right at the top of the candle body, right off of the dual resistance, the 50 and the 15. Now, you are trading down into support, so it's a tougher trade. But with all of these other independent variables in your favor, it smacks right through support and moves all the way to the downside. I mean, that's the power of the COT or POC. And here's another trade. Price falls back to, I label this the POC, it's not. This is the value area low. And you can see clearly on this because it's easier to see the commitment of traders on a green background, how low this is in reference to the candle itself and also to the candle body, all the way at the base. This is really a gibby trade. You're trading off a strong support, and it's dual support. You're trading off this is a modified 15-period moving average. With the point of control right at the bottom of the candle body, and up you go. Now, then you hit the volume-weighted average price, and that's your first decision. You have to decide. Now, here it's not clear whether or not you're going to make or break the trade. The trade's going to stop, or it's going to continue through. And basically, what you have to decide here is either to let it run on with your trailing stop, or just to take it out. If you let it run, it moves all the way through, hits the point of control, where it runs out of gas, and then eventually we get a down candle. Again, if one down candle does not take you out of the trade on your trailing stop, you get a nice move up again. The only point here is that the entry candle is an exceedingly low-risk entry, and that's what you're looking for when you trade. And that's what makes a profitable day trader or swing trader. Those very low risk, potentially high reward trading entries. So this is another trade. I'm just going to skip that. Now, what we're adding here, and again, this is both on Ninja and on Sierra, is a really, if you remember, I showed you the problem with using the raw data from the market delta. That the market delta can be green on a down candle and red on an up candle. And this is the additional indicator that we're including for the first 10 purchases in this webinar. The top line here is looking at the multi-time frame assessment of momentum. Now, and the bottom line is looking at the multi-time frame assessment of order flow. Now, order flow, really, if you want to do order flow tracking, and you want to do it on a tick-by-tick basis, or if you're trading stocks, you're doing it on a cent-by-cent basis, or if you're doing it on the Forex markets, it's on a pip-by-pip basis, you're going to go nuts, because that number in each individual cent, pip, or tick value doesn't have much predictive value. What you want to look at is a moving average of the delta. So we take each delta we take the delta of each candle and we put it into a modified 15-period moving average. and we only look at the moving average of the delta of the two higher time frames that you're trading. We don't look at the delta of your trading chart. So let's say that you're trading a 3-minute. We're looking at the two delta moving averages of your 9-minute and your 27-minute. 3 times your trading chart twice. You're trading a 3, it's the 9 and the 27-minute. If you're trading, say, a 5 range, we look at the next fib number, which is the 8 range, and the next fib number again, which is the 13 range. If you're trading a 377 tick, you look at the next fib, which is the 610, and the next fib after that, which is the 9 something. I can't remember what it is. The point is that the assessment of momentum and the assessment of order flow, which is the delta moving average, does not come off your trading chart. It comes off of the two higher time frames, which gives it enormous predictive power in determining where price is going to move on your trading chart. Now, when this upper line is red, that means momentum on the two higher time frames is aligned to the downside. And when order flow, this lower line, is red, it tells you that the delta moving average on your two higher time frames is aligned to the downside. So the likelihood of price moving to the downside on your trading chart is incredibly high. Now here's an example. I put this in as an example to show you. Now when I did it, the deltas of each candle were 0. But what we're doing here is we're calculating the delta of moving average of your two higher time frames. And you can see when it's red here or orange, price is going to fall on your trading chart. And when it's green or blue, price is going to rise on your trading chart. It does not make any difference what the time frame you're looking at is. It doesn't make any difference what instrument you're trading. It can be, again, it can be a stock, a Forex pair, or a futures market. It's going to obey this rule because this is independent of market or time frame. Now, here's a real example. Now, I remove price, and I remove the price, I remove the label of the instrument, I remove the time frame because this is time frame independent, it's market independent, doesn't matter. Now, there's a lot of different ways to assess momentum. You can use an oscillator, you can use a MACD, but what we do is we strip Heikin Ashi bars of their formula. The Heikin Ashi formula, we modified it to smooth it and to give it more specificity and less sensitivity. So when it's aligned in your direction, the specificity provided by these two independent variables aligned in the same direction, meaning that once price breaks resistance to the upside, you have got to trade it long. If you try to counter trend trade the direction of these two lines, you're almost always going to get stopped out. And you can see these orange candles on all these counter trend traders trading oscillator divergence, MACD divergence, whatever they're looking at, not obeying this, what the traders on the dome are telling them and what momentum is telling them is causing them to take losses. Here's another example. It doesn't make any difference what market this is, and it doesn't make any difference what time frame this is. Price on the two higher time frames, or I should say momentum on the two higher time frames, and order flow on the two higher time frames. And this is real order flow tracking. It's not looking at the tick value of each level on your trading chart. It's looking at the delta moving average of your two higher time frames. And this is an assessment that only we do. And it's on Sierra and it is on Ninja. Now, again, price is almost always going to rise. And if you're inclined to take a counter trend trade, the only time you can do it safely, I showed you one parameter that you must have, and that's the commitment of traders at the top of the candle associated with intense selling off of an area of resistance. Well, you also have to have a turn in order flow and momentum to the downside. Both lines have to turn. You can't have just one turn. Now, what happens when these two independent variables don't align? Remember, I think that we all scratch our heads and wonder, why does the market chop 70% of the time? And this gives you a window into what develops chop. There are independent forces that come to bear on price. And when they align, price moves and you get a trend. When they don't align, price chops. And during this period of time, you have momentum aligned to the downside, but order flow aligned to the upside. And you can see that during this period of time, price just chops. As soon as the two independent forces align, price is going to fall. Now, we're not talking about an entry trigger here. We're talking about a direction. I gave you some great entry triggers, and that is the commitment of traders and point of control, trading right off resistance to the downside. But you know from tracking order flow and looking at momentum that the only trade you can take is short. Here's the same thing to the upside again. Price breaks resistance, and up it goes. I'm sorry, price breaks support, and up it goes to resistance where it's stopped by this low volume node, and this happens to be the point of control, and that's the value area high. Same thing with non-alignment again. I put a lot of slides in to show it because it's really critical. More often than not, these two lines are not aligned because the market spends much more time in chop than it does trending. And it's not enough to look at the moving averages. You've got to look at these other independent variables as well. It's really critical. And price is just going to chop until they come into alignment, and then if you're set for the right trade, you can take a long trade, but the direction then is determined almost absolutely. Now, I wanted to give you an example. Here's a rejection zone, and price pushes through. And once it pushes through, this is just order flow. The only way that you could trade this is short. It hits the point of control. You can't go long, even though you're trading off a support. You just have to wait for order flow to turn, and then you can take a long trade off support. Now with order flow aligned to the downside, you can only take a short trade, but you have to take a short trade off a resistance. So you wait for the point of control to break, price comes up to it, and then you've got a great short trade. Now you're sitting on support, and you can't go long until order flow goes green to take price to the upside. It shows you how you leverage these support and resistance zones, always in the direction of order flow. And here's just another example, order flow only. And I'm going to show you the whole platform together. Aligned to the upside, price breaks, sits on top of support, up you go, right to the upper resistance zone. And if you'll notice, it comes and hits again, but here you don't have order flow aligned. And here's another area. Price comes down to support, order flow is aligned for a long trade. Comes down to support, aligned for a long trade. Down to support, aligned down here for a long trade all the way to resistance. Goes right through the point of control all the way to the zone of rejection. Then if you want to take a short trade here or a counter trend, it's very dangerous because order flow is still green. You wait off of resistance for order flow to turn, then price collapses all the way down. You should take it off at support, and then price turns and breaks support and goes all the way down. Your next potential trade is if price moves up to resistance, and then you look for order flow to be red, and you take a short trade. This is how you avoid taking trades that are likely to lose. If you take a counter trend trade here, not only are you trading into the point of control, you're trading against the direction of order flow. You take a counter trend here off a resistance, the trade hardly goes anywhere, it goes right back up. These are the traders that are constantly getting run over because order flow on the 2 higher time frames has not rolled yet, and you have to wait for it to roll, or price is going to fall a little bit and then it's going to roll right back over your entry and stop you right out. Same thing again, price breaks resistance and then shoots up in the direction of order flow. Well, that's a trade I took on crude, but I'm just going to leave that out. Now, here's the whole system together. And I'm showing it to you on the Sierra version because, it's very well delineated here. And this is how you trade it. It's a set of indicators, but it really comprises a trading system. Now, here is order flow. I'm sorry, the top line is momentum, and the bottom line is order flow. They look a little bit different than they do on Ninja, but they're very accurate. And you see prices right here. This is the value area low, sitting right on it. And you can see that point of control or commitment of traders is right at the bottom of the candle. It's hard to see the intense buying, but it's there. And your trade off of support to the upside in the direction of order flow and momentum provides you with a very, very low risk, potential high reward entry. And that's what you're looking for. This is why I never trade an overbought or oversold market. If the market's overbought, maybe I'll get to my first target. If it's a perfect setup, I'm kind of digressing here a little bit, but it may be a low risk entry, but it's not a potential high reward entry. If the trade is already overbought, what's the probability that trade's going to go through your second target and your third target, give you a full win, or you're going to step away from the trade with $400? It's unlikely. So what you're going to do is you're going to trade within the bound. Now, our overbought, oversold signals are different, but you're going to take a trade right off support when the 15 is close to the 50, and you get a great trade to the upside, and you get a great continuation. You get a pull back to support. This one's a little riskier, but the point of control, or COT, is right at the bottom of the candle body, and it's got a lot of intense buying here. And there's your continuation trade to the long side. And the point of control is a great area to take a trade off of. I love trading off the point of control of the entire volume profile. Here's a trade to the downside. Kind of squeezed it a little bit and only showed you a few candles. But there is the point of control in the upper 1/3 of the candle, very close to the top of the candle body, trading off a resistance, including this value area low, and in the direction of order flow and momentum, giving you a really nice short trade. Here is the same thing. Now here you're trading into the VWAP. That you obviously have to make a decision. This is an independent variable, which is trading into support. You can do it if you have everything in your favor. And one of the additional factors you do here is, well, the 50 is red, the 15 is red, and you're real close to the point of control, which is really, I think, the controlling line on the chart. When you trade short below the point of control, it really increases your chances for a winner. When you trade long, above the point of control, I think it enhances your chances for a winner as well. So you're trading below the POC, your POC of the candle or commitment of traders. And the reason it's called commitment of traders is to distinguish it from the point of control of the entire chart. This is, in essence, is also a commitment of traders. And it's a commitment of traders telling you if you trade above it, you're likely to get a better long trade. And if you trade below it, you're likely to get a better short trade. Well, so this is created and called the COT to distinguish it from the market profile or volume profile, POC. And you've got yourself a great short trade. Intra-trade, you get this alert that's configured to tell you there's a real overabundance of sellers in the market. It almost really guarantees a continuation. Nothing completely guarantees, but this really makes the probability for a continuation trade likely. And you just continue to go lower and lower and lower. And what you're looking for is that low-risk entry trigger. Now, here's what I wanted to do, again, on a reversal. You'll notice that you come up to resistance. And are you going to take this counter trend trade? Well, you look down and you've got momentum yellow. So the answer is no. You need to have order flow and momentum both aligned to the downside to trade in your direction. You come up to resistance again and you look down. Order flow and momentum have not aligned. You're going to see this happen a lot. And if you try to trade without this working with you, all you're doing is increasing your risk. And to become a successful day trader or swing trader, you have to have an anaphylactic adverse reaction to risk. If you take on risk on a trading entry, you need to break out into a rash. That's how much you need to avoid risk. Now this trade, even though the POC COT is not perfect, you just get that alignment. Now in real time, this red line is extended more to the left. You do get an alignment, and here's where you get your fall. You just have to wait. And here's a tremendous trade to the upside. And these are the kind of trades that I say if you wait for them, you know, you back up the truck. And if you it's the Brinks truck that carries the cash away, because you're trading off a dual support. The support is the point of control, and I mentioned how much I love to trade off of it. Here's your POC, or commitment of traders, on the candle, sitting right on the point of control. It's not a big candle body, but you've got that commitment of traders exactly where you want it, and you've got dual support. This is how you have to learn to read price action and market structure. You're trading in the direction of order flow and momentum. Now, I purposely didn't give you perfectly configured trades. A lot of them are perfect. Some of them are imperfect. But if you take them in their totality, looking at everything you have going for you or against you on the trade, there's no way you wouldn't take this trade long. And you get yourself a really beautiful trade to the long side. This is a 13-tick candle. That's almost 2.5 points per candle on the NASDAQ. So what we're looking at is market profile, volume profile, VAH, VAL, POC, low volume nodes, zones of rejection, the delta moving average, the volume ladder, the Heikin-Ashi momentum, and we're looking at the POC and COT of each individual candle. So we're leveraging volume in the most advanced way that's possible. And if whatever other system you're using, if you've got a system, it augments that tremendously. And all of a sudden, if you look back at a lot of the losers you've taken, you'll see they don't align with all of these things that you're going to now see jump out in your face, and they're going to allow you to sidestep losers and they're to get into winners. And I always ask everybody, I'm with a lot of people, and I really appreciate your comment, what is the #1 goal of a day trader or a swing trader? And almost everybody always says it's to get winners, but that's not the right answer. The right answer is not to get winners. The right answer is to avoid losers. If you can avoid taking high-risk trades, if you can avoid entering a trade where the level of risk is rising, then you will automatically get your winners. So your goal is not to trade with sensitivity to get every winner. Your goal is to avoid every loser. And with all of these variables that you get to look at, you really get to make a nice risk assessment on any individual entry and determine the level of risk associated with the trade. And I think it's important for me to say, if you make an assessment that risk is too high and the trade goes on to win, what you have to say to yourself is, no harm, no foul. You can't call every trade right. If you could do that, and if I could do that, all of us wouldn't be here. We'd all be in Tahiti, and we'd own a small island off the coast of Greece. We can't call every trade accurately. All we can do, though, is avoid almost every entry that comes up to us that's associated with risk that's too high. And if you do that, you can make really outstanding money day trading and swing trading. Now, let me give you the offer that we're going to make. Now, for the first 10 orders, get an add-on. The first 10, you get 3 months in the live trading room with me, and you're going to watch me trade the system, and I do my best to avoid risk. Now, we have an auto trader that trades the same system that does it very dispassionately. You have to be very careful. It's one of the hardest things to do when you get frustrated, is to jump into a trade. But you're going to trade it live with me for 3 months. And during that period of time, you're going to get our 10, it's a 10-module educational training series. It's every Thursday. It's canceled this Thursday because it's Thanksgiving. But we go through all of this again. We start with learning how to trade price action. Then we add market structure, and then we add indicator analysis, till eventually we really churn out, I think, educated day traders. And then you're going to get the 3-line indicator. The order flow and momentum assessment is a separate indicator. And it comes with Ninja and it comes with Sierra. So you get all of that. And you learn our trading methodology from the ground up. Normally, it is expensive, but it's only $7.98. And that's a lifetime license. We're constantly doing upgrades. In fact, we're doing an upgrade right now that I just discussed with Sergio, who's really our master coder. He has a master's degree in computer science. We're going to make that assessment of order flow and momentum better. Mathematically, we're going to tighten it to give it more predictive value. And when that upgrade comes, you'll always get the upgrade. You'll always get the add-on. So that's, and let me answer any question that there may be. Hang on one sec. Okay, hold on 1 second here. Finance, Douglas. Yes, interactive brokers will work. That data feed, Jean-Paul, will run the system. It only hooks up to Ninja, I think. I don't think it hooks up to Sierra, but it does work. Now, you have Josh Harris in the room. He's from Interactive Brokers, and he's offering anybody who opens up an Interactive Brokers account a really great deal on your commissions on the whole schlemir. So if you don't have a preferred broker and you'd like to get a great deal, really I encourage you to go with him. He's a real nice guy, and he will give you a really great deal. Minimizing the amount of money that you give away to commissions is really an essential component, although what we try to do is minimize our trades. Exactly, David. Don't trade into the point of control, value area high or value area low. Wait till they break and then take them and trade off of them as areas of support or resistance. That's exactly right. David, I like to trade an 8 range or a 13 range, but I mean, for many, many years, I traded a 377 tick, so it really doesn't make much difference. I could go into a big spiel about why I like to use range bars, but you can really, and the only difference is whether is reading price action on a range bar. I like it the most, but you can trade ticker time real well. I think a 3-minute works really well. I still like a 377 tick on most markets, or a I can't remember that 900 and change fib on the E-mini. On the E-mini, it works. They work real well. My personal preference is an 8 range or a 13 range. We use a 5 range because we trade all the currencies. We trade the 6J, we trade the 6E, the 6B, and the 6C, and another one. I really like the currencies, and they work great with the system. This is recorded, Raj, so you will get it. I do Forex-specific webinars, Douglas. I do. I haven't done one for a while, but the system does work great on the Forex. Yes, I mean, a counter trend trade, if you can get a candle or two, David, you've got nice money. The thing is, though, is if you're going to take the risk of a counter trend trade, I like to hit a counter trend trade big. Because remember, any counter trend trade you take, you're automatically assuming more risk. I mean, you're trading against the direction of institutional money. Institutions create the trend. And what you're doing is you're calling the top. You're saying, okay, here is where the institutional money is stepping aside. Remember, order flow is reversed. Now there's a preponderance of sellers in a market where previously it was moving up strong. Momentum has changed. You're saying, okay, the institutional money that created this long move is now stepped aside, and I'm going to move in and grab the market just as it's turning in the opposite direction. That gives you a little bit more risk, and you'd like to get rewarded for that with a big move. So I think scalping a counter trend trade it can be very dangerous. I don't recommend it. No, this is not the automated system at all, Nestor. This is not. This is the discretionary system on both Ninja and Sierra. It's not automated. David, we do use the market internals. It's just not part of this system that we're proffering to you today. But I think market internals are important. I do. That's a very good question, and I think they make a big difference. Arthur, I'm not sure which you're referring to. The diagram, why would you have that green stripe at the bottom when it was all red before that POC moment? I don't know which it refers to, Arthur. I wish I could go back and look. I'm sorry. You'll have to give me a call, Arthur, okay? Okay, Philip, everybody asks me that question all the time about order flow on the Forex. And if you look at the dome that you're trading on the Forex markets, there's still a fixed number of traders on the dome on the bid side, and there's a number of traders on the ask side, Philip. So you can make an assessment of order flow. You're just using what's on the dome of your trader. Remember, when the bid and ask or market depth on the Forex markets is very high and there's a lot of volume crossing off of the dome, that's when the pip spread is tiny. And when you look up and you can see that that volume is thin and the amount of buyers and the amount of sellers on the dome is small, that's when the pip spread gets wide. So that's the representation we're looking at. If you're looking at the dome on Sierra, or you're looking at the dome, that level 2 data that tells you how many traders are sitting at the bid, how many traders are sitting at the ask, that's got to be shown to you, because that determines the pip spread, and that's what the determination is made from. There is, Charles. Stephen, it can be automated. We don't have this automated. We have the entire system automated. If you're interested in the automated system, you'll have to call us, but it encompasses more indicators than this. This is really all you need to trade profitably. If you have a system that you're currently using and you want to augment it, this will work great for you. If you want the full system on an automated basis, it's just different than what this webinar is. Yes, we will move to TradeStation eventually, Kelly. Yeah, I know, Arthur. I know you're asking that, Arthur, but you're going to have to call me, Arthur, because I don't know what you're referring to, and I apologize for that. Yeah, Josh is with Infinity, Philip, and if you call and ask for him, he'll give you a great deal. They project Sierra beautifully, and Sierra is really, really a nice trading platform. I really like it. Yeah, Infinity is great. I agree with you. The offer expires on Sunday, Caesar. It's a Black Friday all through the weekend. We never, like, give you 8 hours or 5 hours. But if you want to be one of the first 10, you want the order flow indicator and you want the momentum indicators, the add-on, and those are 2 separate indicators. You can use Ninja for Forex, Douglas. Now, I don't know if Sierra does and Infinity provides you with a Forex feed. I just don't know. But you can clear it. You can use the Forex. You can use the Ninja platform. You just need a Forex data feed and you need a Forex account. I mean, I use FXCM and a different broker for Forex. It does work with Forex, Willie. It works really well with Forex. The trade room is open Monday through Friday from about 9:15 until which is when the New York Stock Exchange opens, to up to when we hit our profit target, which is between $300 and $500 a day. And if we do not hit the profit target, I've left the room open all day sometimes, because I don't like to go and close the room unless we hit it. Sometimes we do close not hitting it because the volume just dies. And and it's very important to stay away from a low volume market. David, listen, this works fine on Ninja Sierra. Does the Ninja screen disappear? It does not. I mean, if I had time, I'd open up my Ninja for you and I'd show it to you. And I'd open up Sierra for you. They both project what I showed you really beautifully. This is not automated, Stephen. You have to take these trades on a discretionary basis, make a risk assessment based on order flow and momentum, those 2 lines, on the POC, or commitment of traders, on each candle. It's not tough. It takes a little bit of screen time, But once you get acquainted with the system, it really will allow you to avoid risk. And remember, the first 10 also come into the trading room with me. You're going to watch me trade, and you're going to watch me leverage the system to our advantage. So that's a big plus. It absolutely, Kelly. CQG data will run it fine. That's what I use, in fact. Arthur, I know you're asking that one over again, but I just can't. I don't know which slide. I'm sorry. You're going to have to call me. Yes, we do, Stephen. We do take PayPal. Thank you, Douglas. Happy Thanksgiving to you. The very last slide? Okay, hang on then. Let me go back. Okay, right here. Right here, this is the 50. Now the 50 is sloping slightly to the downside because you see the 50 turns green fairly quickly. This is the 15, which is green. Here's the point of control. The candle itself is an up candle, and you can see that the point of control, or COT, is right at the level of the point of control of the chart. And that's exactly what you're looking for. You're looking for the commitment of traders to be right at the level of support. And that's exactly where it is. It may be hard to see when it's projected, but it's right here. And this really is a very nice long trade. Okay, hang on one second because there's a long question here. We'll tell you, Mike. Don't worry about that. I mean, and a lot of people call and just ask us or send us an email, and you'll know whether you made that first 10. Exactly, Stephen. 2 lines red, the auto trader will only trade short. 2 lines green, auto trader will only trade long. At the end of every trading day in the room, Douglas, I bring my back end in front of the room, and I show my executed trades to everybody in the room. We trade with chart trader up, every target, every stop, every profit target hit. We have an ongoing running profit loss in the room off a chart trader. Everything is transparent. Kelly, 4.5 years we've been in business. Yes, Stephen. Yes. It's addressed through the strategy analyzer, momentum, order flow. Yes, you should, Jean. You should use the VWAP as an area of support and resistance. Absolutely, Kelly. It all depends. Yes, you can use them to display weekly and monthly profiles. The only thing we don't do is we don't display multiple market profiles. You can do it with Sierra if you want to. I just have not found it helpful. On both software systems, we accumulate data on a look-back period, so you're not looking at one day's volume profile on any chart. I don't believe assessing volume for any given day is enough. So we do accumulate data on the volume profile, so you're not looking at a daily anyway. So it does have throw weight on the areas of support and resistance projected as being the VAL, VAH, and POC. Yeah, John, yes, we'll give you more than one license, and I'm putting that out into the room. So if you're one of the first 10, we'll give you an additional license to run it on a second computer. No problem with that. That's a lifetime license, is $798, and like I said, it includes all upgrades, it includes all add-ons, and we have really every time we find something that's different, that gives us that gives this more power, we add it. And we're spending time right now, will be done after Thanksgiving, modifying the momentum and the order flow lines to make them better. And you always get those upgrades. No, you never pay additional for upgrades, JD. We give out stuff to upgrades for people who own the whole system you wouldn't believe. Once you pay, you don't pay us again for whatever you purchased. Yes, if you currently own, you know, John, you always get the upgrades. I'm so how. I mean, these are green, looking for a long trade, Arthur. I wish I understood. Let me just look again here. Is on the order flow down below. How is that upper band at bottom green during those two big? Oh, okay. Oh, okay. It's simply because of this, Arthur. Remember, we're looking at the moving average of the delta. If you look, I see what your question is now. Let me tell everyone what Arthur's question is. We've got two down bars here, and momentum stays green, and order flow is neutral. Why does this not change this color? And the reason it doesn't is exactly what makes it predictive. If this was assessing this was assessing order flow and momentum on your trading chart, Arthur, it would go red. But it's looking at the two higher time frames. Remember, it doesn't care what price is doing on your trading chart. That's what gives it its predictive power. So what you see, listen, the conundrum that faces every trader on every entry, every day on every market is, are these two pullback candles the beginning of a new downtrend or just a retracement back to support for the continuation of the trend long? By looking at the two higher time frames, we answer that question. You are not going to take these candles short because momentum hasn't changed on the two higher time frames. Order flow is neutral. You can't take a short trade. And then when you hit support, order flow and momentum align to the upside. That's the whole purpose of the system. This down candle on everybody else's charts is going to move order flow and momentum red. Well, that's telling you what you already know. Who cares if that happens? What we want to know is what's happening on your two higher time frames. Are we going to anticipate this red candle as a pullback and a long continuation and a continuation of the trend? This is what these lines tell you. And that's why they don't flip. And that's why any indicator that assesses data from your trading chart it tells you where price is been, it doesn't tell you where price is going. This tells you where price is going. And that's why they don't turn color on these two candles down. And remember, I told you about taking a counter trend trade and saying to yourself, okay, well, these two red candles are the start of a downtrend. You wouldn't even think that with momentum green and order flow neutral. You wouldn't think to take this candle short, and if you did, you wouldn't get anywhere. You'd get half a candle to support and then get run over to the upside. Okay, now I think I got your answer. Yeah, any owners always get upgrades, John. And if you don't have these upgrades, just let us know and we'll give them to you. And I think I got your answer. I hope, Arthur. It's because of what's going on in the higher time frames, not on your trading chart. We don't care about what's going on your trading charts. The purple dots. I'm trying to see where there's a purple dot. Are these the purple dots that you're looking at, David? No, these purple dots are a visual representation of the candle body. They're telling you where the candle body is. In case it's hard to see the outline, all you have to do is look at these purple dots here, and there's one at each tick level that comprise the candle body. It's just another visual representation of the candle body. Kelly, you know, right now, we're right after Christmas or right after actually Thanksgiving, we're putting up a new website. All of our brand new videos are there. So I don't have much more on this than I'm telling you. Unfortunately, we've got great videos on the new website, and it's just about to go up. If you have any questions, you can always call me. I'll be happy to answer anything. I mean, here's the number. I mean, we just live here in the office, so you can call anytime, believe me. You know, I have your email up, and Sergio and I are working on it for you, Warren. I know I always tell you that, and I promise you we are, and we're going to deliver for you, Warren. I promise you. And I'm telling this out loud to the crowd. I mean, every time I open every morning, I see you, Warren. Okay, go back to the CL chart. Let me go back. I'm just not sure which. Is it, okay, this one? Is it that one, Gene? Thank you, Arthur. Thank you. Thank you very much. Thank you, David. Thank you, guys. Have a great Thanksgiving, too. Really. Thank you. All right, well, listen, everyone. Have a really happy holiday. We're the small fry here in this market. We've got the institutional guys. We have to take money from the other small guys. I mean, when you trade these financial markets, it's the ultra-capitalist system. I mean, we don't create money or destroy it. It just changes hands. And we have to ensure that the money that changes hands changes into our hands. And all we're doing is reading the direction. Ultimately, all we're doing is reading the direction of money flow. The point of control, value area high, value area low, volume weighted average price, momentum, and order flow are determined by the institutional traders and the big money. We want to trade with them, and there are all ways of determining where the big money is going. That's why we look at the two higher time frames, because they have strong predictive power in determining where price is moving on our trading chart. Let everybody else take oscillator divergence off their trading chart, take MACD divergence off their trading chart, take Fibonacci support and resistance off their trading chart. We will run them over because we do a multi-time frame assessment and we really accurately predict the direction of money flow. So everyone have a wonderful, wonderful Thanksgiving. I'll see you after Thanksgiving, and between Thanksgiving and Christmas, let's beat these guys up and take money. Have a great holiday again. Take care. If you have any questions, feel free to call me anytime. Okay, John, yes, let me see. Thank you, Herman. I appreciate that. Again, John, even it's a visual, we're telling you what's going on the two higher time frames, and it has tremendous future predictive value for where price is going on your trading chart. If you have order flow and momentum long on the two higher time frames, it's very rare that price on your trading chart is going to go in the opposite direction. And if you try to go in that direction, it's gonna run you over. Take care, all. Have a great Thanksgiving. Bye-bye, all.